Hello, everybody. This is Macro Dashes, and we are talking about Global Trends ETF for the new quarter coming up. It's done about a week early. I will have the plug and play dividend stocks and the plug and play growth stocks this weekend. And then we'll start doing updates on a week-to-week basis for what we're trading or just doing analysis. To make things very easy for people. So we'll work off of these quarterly updates and then go week to week on what we're doing. Make sure you mind the slices or sleeves in your portfolio. Scale in slowly and wide apart to moderate risk, and because you can't be perfect. Remember, excellence over perfection. It's very rare that you can buy something once. We got our first breakage in the banking system. I've been talking to you about that for about a year and a half, that as the Fed tightens, that would happen. The next wave of breakage is bigger and will offer some pretty interesting opportunities. If you own bank stocks, you should sell them. And if you want to buy them back, I think you're going to get a chance to buy them back at a 30 to 50% discount in the not too distant future, the big banks in particular. There is $1 trillion wall of refinancing coming. So between now and the end of next year, there's about $1 trillion of loans that have to be refinanced. And, that's an awful lot of money. There's probably going to be a lot more banks getting properties back than you've seen since 2009. So in the short term, the dollar is going to be choppy. You might get one more surprise from the Federal Reserve or just from the globe in general that sees the dollar jump. But we've probably set the high on the dollar, and the dollar should drift down in bits and pieces to the bottom of its new normal higher trading range. What you've been witnessing in the last year or so is the new normal being put into place. And what is the new normal? Well, it's a lot like the old normal from 20, 30 years ago. Essentially, you're going to see moderate interest rates versus near zero. And even when the baby boomer retirement crisis comes, I'm not positive that you'll get near zero, because I think everybody has concluded that zero interest rates have a lot of negative repercussions from bad investments made off of that low interest rate. I think they're going to control the balance sheet more through quantitative tightening and easing going forward. As I suggested on MarketWatch, why don't they raise interest rates but do quantitative easing? You just finally saw that happen for the first time. The Federal Reserve is continuing with quantitative tightening as their policy, but you saw $300 billion go onto the Fed balance sheet in the last couple of weeks to help out the banks. So there was an uptick, essentially quantitative easing, a whole different structure than what they would do to stimulate the economy. They did this to just protect depositors and keep banks from failing. And the banks were failing not because of bad loans, but because of really stupid mark-to-market rules. So I'm not really certain why they insist on mark-to-market. And they got around it by the Fed basically saying, all those things that you're marking to market, we'll take them off your hands and give you cash, and then you can buy them back, loans, whatever. So it's kind of silly to me why they're doing what they're doing. And this is the first thing that I think about when I think about what's going on in banking, because it's not the Fed that's screwing things up. The Fed is fixing things that Congress has screwed up. So it really is on Congress to fix all of this, because if you're on the left, you generally have jumped into over-regulation. And if you're on the right, you've generally jumped into under-regulation. I don't know. They need to find 60 senators in the middle who can say, look, Liz, you're too extreme. And look, whatever, there's 30 idiots on the right. You're too extreme. So you got 5 to 10 idiots on the left, pushing 30 idiots on the right at the moment. Can they find 60 votes to do things the right way? I don't know. And the reason that's important is because if they can't figure it out and get 60 votes in the Senate to figure this out and get it done right, maybe they will give us another crisis. The Fed is doing a really great job. And I know that's not the common narrative, but the Fed is doing a really great job. They really are. It's everybody else that's screwing up. You've got bank executives investing their money poorly. You have Congress without the will to use their brains, or without the brains to have a will. So we'll see. I think that things will work out because A, I'm an optimist. B, things have always tended to work out. Pretty good track record there over the last, since the Dark Ages, especially since World War II. So we take a look at everything that's going on and you start to think, okay, how do I break this apart into pieces so that the whole story, right? So the novel makes sense. How does this all become chapters in a novel, all working together? It's a lot of moving parts. Now, a couple of things. To see the full list of ETFs, make sure you apply to get access to the spreadsheet, the very short list. It's right here. It's in the top menu at Fundamental Trends. Click here, the list pops up. But if you don't already have access, you will get a button that says Request Access. Press that button and request access. I get a notification in my Gmail, and I almost look at it every day. But within a day or two, I'll give you access. Once a year, I'm going to change the address. Then everybody has to reapply for access, but I'm not going to do it more than once a year. So we just did it in December. We probably won't do it again until next January. Some investment quick thoughts. We got the first breakage, and this is what you have to worry about coming up, is that big institutions and big investors are going to give buildings back to the banks. It already happened. Blackstone did it, right? And this is just the offices. The rest of commercial has a lot going too. Already in Milwaukee, I am seeing Class B office buildings, and it really started last year, go up for sale. And what they're asking is categorically between 10 and 30% overpriced. They're never going to sell for those prices. And they can't ask for less because of what they owe. So they're trying to sell these buildings for what they financed them at 3, 4, 5 years ago, and they can't get what they owe on the building. So what does that mean? They're going to end up giving these buildings back to the banks. Then the banks will own them. And as we know, it takes a bank a year or two for some inexplicable reason to sell off these buildings. So if you're looking for a building, you should be squirreling away as much cash as you can right now, because sometime in the next year or two, you're going to be able to buy the building that you want at a pretty good price from a bank. And the way the deal will work is that you can go to them and say, I'll buy that building, and you lowball offer them, you give them a lowball offer, but I'll finance it through you. And I need to rehab the building, and I'll take the rehab loan through you too. So by getting the building very cheap, who cares where you finance it? Maybe the bank nicks you for an extra quarter point because they're sneaky like that. But if it comes out of the purchase price, who cares? You just get it back through the purchase price being lower. Quarter point times 10 years, because you can usually get a 10-year note. You can usually get a 10-year note on the smaller stuff. The big stuff, they make you refinance every 5 years if it's not paid off, for the most part. So we're going to see the resets in the banking sector and the real estate sector over the next year or two, maybe 3. But the Fed is winning the war on inflation, right? Real estate prices have started to come down. That was one of the wars, or a battle within the war. Over the course of this decade, you're going to see housing change dramatically. So as the office towers get bought, the office towers are going to move to being 40 to 60% residential. They will convert the upper floors into condos. That's going to happen all over the country. And a lot of people who work downtown are going to end up living downtown because, hey, why wouldn't you live a few floors up from where you work or across the street, walking distance? And the downtowns are going to have a transformation of more and more people living there. And some of these small buildings are just going to get torn down and turned into green space. It's already happening. I don't say things like this if it's not already happening. It's not speculation. It's coming. Take a look at Manhattan. If you want to add stories to a building or build above a building or tear a building down and make a new taller one in its footprint, you have to find offsetting space to turn green. It's going to happen all over the country. Over the next decade, as the boomers age and sell their houses, they'll move close to healthcare and places that they like. Those houses will get absorbed by the millennials and Gen Z. Immigrants will move into the places that the millennials and Gen Z left, and inventory will go up because of all the new housing in the towers. Guys like me are developing condo complexes, which are trying to. There's a lot of change coming, and it will move roughly in balance. And I don't think you're going to see quantitative easing for a long time until the baby boomer retirement crisis. That's different from all these knuckleheads who are trying to spin trader narratives. I think that next year we might get rates cut a little bit. About this time next year makes sense, a little before, a little after. I don't think you see any rate cuts this year, and I don't think you see quantitative tightening cut this year because they're going to have to offset what they do to help the banks. So they're going to try to keep the balance sheet neutral, take it off from one spot, put it on in another spot. Left pocket, right pocket, doesn't much matter. Because the banks are going to be short on cash, because as they get the keys back, they lose cash flow. It won't be quantitative easing in the way that you think about it, because it doesn't need to be, because employment is tight. Even with all these tech people losing their jobs, after they enjoy summer, they'll all get new jobs, or they'll consult, or whatever they'll do. That will probably halt wage inflation because it mainly came in tech and in services. Services inflation is going to be there until we allow immigration. So that'll at least be a little bit longer lived because you know it's going to be difficult to get immigration. But over time, these things balance out. Now, the Fed balance sheet, like I said, jumped a little bit recently because of the banking issues, but they're going to pull it back down. And it's going to be a choppy thing with the Fed balance sheet because as they have to give money to the banks so that the banks don't, collapse under stupid mark-to-market rules, but in the future, it actually will be bad loans. There's a lot of choppiness coming in the next year or two. I do think that once the Fed pauses, which I think comes after the May meeting, I think the May meeting, they raised a quarter point because one of the other inflation battles is imported energy prices. But I think we're close to being done having to fight Russia and OPEC on oil. The shift to alternative energy and EVs is just going so fast that there's going to be slack in the energy markets in a few years, 26, 27 years that I keep pointing to and have been since 2020. It's easy to project these things out if you actually know what's going on. And after CES 2020, I told you this is what's going on. And in 2026 or 2027, you're going to see an inflection point. But between now and then, it's still pretty strong growth rate on the shift to alternative energy and EVs. We just got news from Tesla that they're not going to have to use as much in rare earth metals. Everybody will adopt that. The batteries are going to double in efficiency in the next 3, 4, 5 years. One of our battery investments is halfway there. They'll adopt the lithium air technology that just came out that we actually talked about 2.5 years ago, that would get developed closer to 2 years out than 10 years out. And here we are 2.5 years later, and the announcement came out. So all these things are moving so fast. And yes, the AI and the robotics are moving fast. What did I tell you? Who did I tell you were the most at risk from AI back in 2020? Does anybody remember? Middle management. Yeah. Organizations are going to become more horizontal. The AI is going to be an assistant to everybody. Your manager is not going to have to look over your shoulder because it'll have the metrics to know whether or not you're doing your job. It doesn't have to browbeat you. Now, you'll still have that asshole once in a while that wants to, and you're going to have to learn to very politely say, go fuck yourself, and it'll all work out. Because we are xenophobic, we will not ever allow enough immigrants in to truly fill the labor shortage. I wrote an article that mentioned this book. When George Freeman wrote that book, he said that there'd be a labor shortage in the 2020s. And I agreed with him because of the demographics. And I've been on the demographics argument a long time, going all the way back to the late 1990s. The reason I've been mostly right on my macro analysis, and there's timing issues for sure, because governments and central banks get in the way. But the two reasons I've been mostly right about most of my macro analysis most of the time is that it's all based on two things. What is it based on, Teresa? See, when you give answers, you get called on. Demographics and energy. Demographics and energy drive virtually everything in economics, followed by technology. So when you take a look at demographics and energy and technology influences technology, technology influences energy. If you just stick with those three big themes, and then you account for the way that governments and central banks push and pull on things and occasionally break them, backtracking, the Fed bazooka is almost loaded now for the coming baby boomer retirement crisis that should hit late this decade, 2030-ish, couple years early, couple years late, but in that range. That is when you're going to see gigantic quantitative easing. Between now and then, I think the balance sheet chops along, and the cover again is the fact that the labor market is tight, so they don't have to lower interest rates much, even if they do start doing it next year a little bit. They for sure don't have to go from quantitative tightening to quantitative easing. There's record amounts of money in money market accounts. That's going to flow into hard assets, mainly real estate. We're going to talk about deflation going into the baby boomer bust, and then they'll inflate their way out of it. So what do you do between now and then? You make smart investments. So make sure you're carrying the appropriate amount of cash. You should be investing in the spots. I've changed the way that the core holdings work, just basically doing the market cap levels. You can use any of these funds for your large cap allocation or combination thereof. I think everybody should have some Berkshire Hathaway. They're probably going to end up owning a bank soon. These are the two best mid cap funds I found, two best small cap funds I found. My criteria are pretty simple. It has to be liquid and have adequate market cap in it so that we can't get stuck. And it had to be a top performer over multiple time frames. I do a lot of charts that look like this one, where I compare the S&P 500 to different funds. And this chart, the S&P 500 is purple. See that it's on the bottom. All of these other funds, QQQ, right, this multi-factor, all did better than SPY. BlackRock Science and Technology, I didn't put on that chart, but total return, because it's kicking out about a 10% dividend from selling options, much better than its price appreciation. You tack on 10% in income, it's a big deal. So these are your core holdings. And remember, this is 100% of the slice, not of your total portfolio. So you have 3 slices in your portfolio, how much you're going to carry in cash in the short term. This is your long-term target range. And we've been at the high end of our range, but that should be falling now as you invest. Then you have your tactical and trading slice after the core. And here I have unallocated cash because I'm waiting for certain trades. Clean energy is a gigantic trend, maybe the biggest trend in the economy. Got to have some. Q Clean trades with a high correlation to Tesla. So if you don't want to buy Tesla individually, it's a big holding in this fund. So when Tesla dips, you can buy Q Clean. PBW is more small and mid cap clean energy. I don't have any of the solar fund right now, but it was the top performing fund over the last 5 years. So a little deeper correction, I want it. I don't have the select energy at the moment. Needs a deeper correction. I'm happy owning my basket of stocks because they're very carefully picked out. I don't much like the index here unless it's on sale. Hard to get a discount on the semiconductors. We almost got it. The October bottom might have been the bottom. So if we approach that again, probably have to buy this unless there's a crisis developing. And a lot of things I'm saying are unless there's a crisis developing. I don't see a crisis. I just see a run-of-the-mill recession and a pretty quick rebound out of it because they really don't have to fight inflation much longer. We already see prices coming down across the board. We just have to prevent Russia and OPEC from manipulating oil prices into the election. Then once that election is over with, we're not going to care again for 3 or 4 years. And by then, you're going to have panic pumping and more oil and gas, and you know what to do with because so much new energy from alternatives is going to be coming online by then. And you already have 1 in 11 cars being sold, EVs, that's accelerating. All of these things point to 2026 and 2027 as the return of cheap energy. Go through this. I have my notes and thoughts here. And remember, don't catch falling knives. If there's a credit crisis or some financial crisis developing and everything's going down, wait for the day that the Fed says, okay, it's over now, we're going to fix it. Mind the real estate. It's a big deal. Mind oil. I did an interview at Forex Analytics back in September when oil was just getting under 100. I said that the trading range in oil would be 60 to 80 for a long time. And here we are, just a couple months later, that's where we're at. At some point out here, because of all the EVs and solar demand, or all the EVs and solar coming, that'll coincide with panic pumping, everybody pumping what they can to make sure they can sell it to the remaining fleet of ICE vehicles, right? It'll take 10 to 15 years for a lot of those ICE vehicles to get off the road. That is when everybody has to try to sell their oil, and you will see the price of oil get probably down into the 40s or 30s even sometime in the second half of this decade. Remember, I said this. So unless XLE tests this line, I don't think I want to own it. So I need to price a little under 70. It's not there yet. Start thinking about other things. I think it's important to think about Bitcoin. If you haven't been paying attention, Bitcoin is a thing. It's so much of a thing that the government is trying to figure out what to do about it. I strongly encourage you to look at her Big Ideas 2023. I mean, it's a book. I'm not even all the way through it yet, but look at it. Because what you're going to find is that a lot of the things that I started talking to you about at CES 2020, the time frames I gave, they're all pretty on point. And remember, and Kathy pointed this out on Bloomberg yesterday. She goes, look, I'm not an asset allocator. My job and my defined fund objectives, but I have to follow for regulatory reasons, her charter isn't to be an asset allocator. She's investing in technology and innovation. That's it. Now, I do think that she could have held a lot more cash on the way down. I'm not sure if she can go over 20% cash by rule, but whatever she was allowed to go up to, 20, 40, 60% in cash, she should have. She should have done what we did, but that doesn't make these ideas wrong. It just means that there's volatility. Everything is moving in these directions. And there will be things that edge in one direction or the other, a little to the left, a little to the right, a little up, a little down, a little different. But this is the big picture, and it's about right. One of the things is Bitcoin. I am not wrong about Bitcoin being adopted by emerging markets and the wealthy. And at some point, that will become so apparent, the price will have gone so high that you're going to ask me, should I buy Bitcoin here at 60,000 or 80,000 or 100,000 or 140,000? Just buy it. Buy it now. Put a portion of your bank savings into Bitcoin. If you got 100,000 in the bank, put 5 or 10 grand into Bitcoin. If you got 10,000 in the bank, at least start dollar cost averaging $100 or $200 a month into Bitcoin. Now, one of the interesting things is you're getting some research out there right now from Hindenburg saying that Block basically enriched the executives. Duh. Haven't I been telling you this story for a long time? That the executives skim the companies that they operate? So I haven't read this whole report. It just came out today. They teased it yesterday or 2 days ago. Square is overvalued. And now, hey, look, I think he's too late in issuing this report. He should have issued it up here, right? Square owns Bitcoin, and I am very familiar with Square's business model. My daughter uses it. A lot of my friends use it. A lot of businesses use it. And they offer a lot of things. It's not going to fall off the cliff. The company's not bankrupt. They have plenty of money. They have all kinds of revenue. They make loans to the businesses, the small businesses, based on the cash flow that they have the data on. So Square loaned my daughter 40 grand based on her cash flow. And so you're going to pay us back 20% of your receipts weekly until you pay us back. Now they'll lower it to 9% of the receipts weekly if you're tight. But my daughter took a 3-year loan, 40 grand. She's going to have it paid off in like 13 or 14 months. They don't make bad loans because they know what the businesses are earning. How do they know? Because they're the ones handling the transactions. It's the same reason why the banks all just gave me a ton of credit. They said, you haven't applied for any credit cards or loans, but how would you like a credit card with no interest for 18 months? Because they can see what I'm earning. So I don't have any long-term concerns about Square. I'm going to read this. I'm going to update this, see if maybe we are going to set a new low, but I love Square. Great business. Nothing but upside as the world transitions, as the economy transitions. So we can get this one even cheaper. We're going to want it. And the fact that they have Bitcoin on their balance sheet, that's an asset that's probably going to go up 500 to 1,000% in the next several years. And if I wasn't 1% worried about the federal government trying to kill it, I wouldn't talk about it so much. Actually, I would talk about it more. If it wasn't for the federal government, I'd probably have 20, 25% of my money in Bitcoin. I would, at least until the next FOMO rally. And then I dial it back to a normal asset allocation of a few percent. Coinbase got a Wells notice, also because of what they're doing with cryptocurrency. Here's what I can tell you about the Wells notice from the SEC. It is wildly inconsistent with precedent. Wildly inconsistent with precedent. Here's what's going to happen. Coinbase is going to win. They might tie. They're not going to lose. I'd say it's probably at least 70 to 80% likely that they win. Pay a fine, slap on the wrist, change their operations just a little bit. But right now, there really isn't a lot of regulations here. Although Coinbase already is regulated under the commodities CTFC. And the guy who runs the SEC, frankly, appears to be a knucklehead. I wasn't sure. Academic, highly partisan. If he had a real goal, he would go to Congress and say over and over again, write these regulations. Here's an outline of what I think. He's not doing that. I think Gensler needs to be fired, which means that probably he'll come down on my hedge fund when I launch it. So Coinbase also way at the bottom here. These pieces of bad news after big declines, that'll help us put in the ultimate bottom. And then you want to buy because Square has a very bright future. Coinbase has a very bright future. If you don't want to buy the companies individually, buy them in a basket. The ARK Next Generation Internet Fund, Coinbase and Square are both top holdings, and so is the Grayscale Bitcoin Trust. I wrote an article about back in the autumn and said, here's who should buy it. Now, the Grayscale Bitcoin Trust is very difficult to get into an IRA. You basically have to be an accredited investor, or they make you sign up for advanced trading capabilities. But because it's stuck inside of this fund, you can get the benefit of it. What's going to happen with Grayscale Bitcoin Trust is one of two things. Either A, they distribute the Bitcoin and everybody gets cash, or the discount on the fund comes down to single digits. So the difference between ARKW, the Internet Fund, and ARKF is basically that ARKF does not have the Bitcoin. ARKW does. The corporate holdings are essentially the same, very similar. You also get Shopify in here, so I like that. Shopify is beat up. So ARKW, it's close to a bottom, right? This is the long range. Here's the shorter chart. These are kind of the different targets. The return of the Fibonacci line. In the short term, I like the fibs because it shows me where the retraces are. And in the long term, it just kind of ballparks it for you. So I don't know if it holds this line. I think it would be unusual if it did. Shooter is saying this might form a 3 drive. If it does, what's called a 3 drive is one of the best predictors of a breakout. So we're going to watch this very carefully. And I'll give you a buy alert when it's time. There's different prices this could come down to, depending on what's going on, largely dependent on how aggressive the government is, what the courts say, things like that on the Bitcoin stuff. But this is a way to get some Bitcoin into your IRA if you can't get GBTC, which most of us can't. I have it in my account. So, you have to check with your brokerage, but like Merrill Lynch won't let you do it. A lot of the brokerages won't let you do it. I think you look for the 3 drive over the next several months, right? The time frames look about right in this range. So we'll have Shooter work this up for us. I was taking a look at First Republic Bank. I just point something out here. They're about $30 billion short on cash. They just borrowed it from 3 big banks. So they have temporary $30 billion. But they need a permanent $30 billion. Did you know there's this company in Omaha that loves to make $30 billion investments? Look at the market cap, a little under $3 billion. So if they diluted this by 90%, basically every 10 shares becomes 1 share, because Berkshire Hathaway puts in $30 billion and ends up owning 90% of the company, which means they can put the consolidated results on their own balance sheet without actually owning the whole company. Now all of a sudden you have a company that's between 10 and 20% on the stock market, because I'm sure they do a capital raise to get it closer to 80, but 80 something percent owned by Berkshire Hathaway. This bank could then buy the remnants of SVB Bank or whatever other little regional banks need a helping hand. This could be the bank that facilitates consolidation in the space if Berkshire wants to use it to do that. I know that they've talked about it. I don't know what was said. It wasn't on that wall. I'm not the fly on that wall. I just know who went in the room. I don't think I'd be surprised to hear an announcement that Berkshire Hathaway is buying all sorts of the company, right? A major part of the company on a private placement. Make it so. And by the way, if you need money, give us a call. We'll figure it out. Kind of like what they did with Occidental Petroleum. Keep an eye on First Republic. If you're feeling gambly, I think you can sell puts on this. I think it's cheap enough now. You can even buy shares because the share price would jump if Berkshire gets involved, right? Yeah. So Credit Suisse is getting bought out for 10% of value. I think that's what can happen here. I don't think the Credit Suisse deal is done, but I think something's going to happen here. And if you want to do something speculative, they're not letting this bank go under. That's kind of the point here. I think if you're a stock investor and you want to have something, put a 0.5% of your money into that, might go up, back up towards 100, you might want to do it. Could go to zero though. I mean, that's the risk. I mentioned semiconductors earlier. This might have been the bottom. Tom Lee says it is. So either we get a retrace in here or we get a double bottom. I'm not so sure. Without an Armageddon scenario, I don't know how we get back down into here. I think there's a very few sellers in this range. I think the selling dries up in here. So a price closing on 300, I think would probably be awesome, but we might have to buy it in the middle 300s. We'll see. All right. So the last thing I want to talk to you about is the emerging markets funds. I got rid of EMQQ. It doesn't mean that you have to, right? It was a great trade. We bottom ticked it in the middle 20s, made 20, 30%. I sent out that notice a while back that I sold most of it. I'm completely out of EMQQ right now, but I am adding these funds, the iShares Asia 50, and I want to show you the roster for the 401k. And these, I just had to have initial allocations for the 401k, for the Blue Mountain Growth ETF asset allocation that I'm running. These 5 funds have varying amounts of China exposure. The Wisdom Tree Emerging Markets Small Cap is 20% China, and the Asia 50 is 40% China. So this allows me to control how much China exposure I have. And I have alternatives. The Vanguard FTSE Pacific is very similar to this 50, but without the China, and they actually have way more holdings, so more diversified, more of a pure Asia play ex-China. Then the Freedom 100 Emerging Markets, they don't invest in any countries that aren't essentially democracies. So no authoritarian governments. We've got a Latin America fund, correlates closely to Brazil, but not exactly, and it's more diversified. Australia, because they pretty much only go up, and Wisdom Tree India earnings, because among the India funds seems to be the best one, highest quality holdings, and India, of course, is in a pretty good spot long term. Take a look at this chart here for the India fund. Again, it retraced to this first level, and it's holding it. I think it's going to get down into here, and it might actually, I should probably lower the bottom fishing, but I think we're pretty close. This line here, you start running out of sellers, you start coming in the big buyers. The big buyers usually move up over time. This top line is probably where we're going to get it, is in the upper 20s, could be the mid 20s. And if there's a crisis, it could be down here. Asia 50 is coming off a bottom. I could do a smaller fib retracement. That means that 54-ish probably is where it retraces to, and then we can buy it. And that makes a lot of sense, right? This is the same rally from EMQQ that we saw, and now we're getting the retrace right about 54, right? A 618 line would make a lot of sense. Could get worse, right? Crisis, go back down to 50. If the dollar really gets super strong again, get back down in here. I think the dollar being super strong is probably over. All right. So when you take a look at the very short list, when a lot of you are on at once or it sits on your screen, you got to reload it. But anyway, I'm updating this. It'll include all of these funds now, if they're not already on there. There's a designation for whether or not it's in the 401k plan. So if you don't want to use industry funds and country funds, the 401k will be more sector-based and market cap-based. All right, I have an appointment to take this afternoon. I will get this up on the internet tonight. Take care.